when you step back, supply chain finance shifts the dynamic, right? Instead of being a negotiation where one side wins and the other one loses, it becomes a mutual and beneficial financial strategy. Both parties are improving their positions, and that leads to a stronger, more resilient supply chain.
Welcome to Actualizing Success. In this podcast series, our in-house advisors discuss today's finance and technology topics with an emphasis on solutions that embrace tomorrow.
Hello, everyone. We're here today to get a deep dive into the supply chain finance subject, how to unlock the working capital with this tool and this financial tool that can be leveraged from the different corporates. So today we are joining with Adrian from Actualize Consulting. Thanks, Adrian, for being here.
Yes, thank you, Martin, for having me. I'm really excited to talk about this topic. Supply chain finance is a topic that's becoming increasingly important for organizations to look to improve both liquidity and resilience. So without further ado, let's discuss supply chain finance.
Thank you, Adrian. Thank you. Thank you again for joining us now.
Sure.
So, in order to start from the very beginning, let's talk about first, what is supply chain finance? So can you please let us know what exactly is supply chain finance and why should companies care about it?
Sure. So at its core, supply chain finance, or also known as SCF, is a set of solutions, right, that helps companies optimize their working capital by improving how and when suppliers' payments are made. So typically there's a bit of tension in the supply chain, right? You have buyers that want to hold on to cash as long as possible to maintain liquidity. And on the flip side, you also have suppliers that want to get paid as quickly as possible to fund their operations. So that mismatch can create strain, especially for smaller suppliers who rely heavily on consistent cash flow. And what SCF, supply chain finance, does is that it bridges that gap. It allows buyers to extend their payment terms, for example, from 30 to 60 to even 90 days without impacting their suppliers. And at the same time, you have suppliers that can also choose to get paid early by a financing provider, third party, or a bank. And this is often at a lower cost because the buyer's credit history is used to secure the financing. So instead of a trade-off, it becomes a win-win solution for both the buyer and the supplier. You have buyers that want to improve their cash flow and free up working capital. And you also have suppliers that gain faster access to liquidity and more predictable cash inflows. The other part was the question on why should companies care? Well, in today's environment where you have interest rates, supply chain finance disruptions, and liquidity pressures are all top priorities, supply chain finance can become fundamental, right? It's not just about payments, it's about building supplier relationships, increasing resilience across the supply chain, and creating a more stable and efficient financial ecosystem.
Oh, yeah, very interesting. Yeah, thank you, Adrian, for all your thoughts about it. Moving on this interesting subject, now we will talk about the challenge that the working capital can represent for companies. You mentioned previously that about financial flexibility. So what's a typical challenge companies face when it comes to working capital?
Yeah, it's a great question because that's really where the problem starts, right? At a high level, most companies are constantly trying to balance liquidity. They need to make sure that they have enough cash on hand to run the business, invest in growth, or manage uncertainty. And one of the biggest levers they have is working capital, and specifically payables. From the buyer's perspective, the goal is usually to hold on to cash as long as possible, which includes, like I talked about earlier, on extending payment terms, moving from 30 to 60 to 90 days. And that can significantly improve cash flow and free up capital for other priorities. But on the flip side, suppliers, especially the small and mid-sized ones, they often depend on timely payments to fund their day-to-day operations. They have some examples include like payroll, raw materials, or other costs managed. So waiting longer to get paid can create real pressure on your business, right? Especially for smaller ones. So without a structured approach, you end up with this built-in tension, like I talked about in the beginning, where buyers push for longer terms, suppliers push for shorter ones, and that can strain the buyer-supplier relationship. In some cases, it can even introduce risk into the supply chain if suppliers face liquidity issues. So that's where supply chain finance comes in. It essentially introduces a third party. This is typically a bank or a financing provider into the process. An example is that once an invoice is approved, the supplier has the option to get paid early by the financing partner, often at a favorable rate tied to the buyer's credit profile. Meanwhile, the buyer still pays on the extended terms they've negotiated. So you're aligning incentives instead of creating friction. You're also improving working capital for the buyer while giving the supplier faster, more reliable access to cash. And that's really the key, right? It turns on what used to be a point of tension into a coordinated solution that supports the entire supply chain.
Yeah, understood. Yeah, that's correct. And very interesting. So now let's move to how a supply chain finance program can create value to companies, to corporates. So in that order, how does an SFPF program can actually create value for both sides? I mean, for buyers and for suppliers.
Sure. So maybe if we start with the buyer. So in the buyer organization, supply chain finance gives them a lot of more flexibility and control over their working capital. For example, it puts them in a stronger position to negotiate extended payment terms with the suppliers because they're not asking suppliers to simply wait longer. They're offering them an alternative way to get paid early. And in turn, that allows the buyer to also hold on to cash longer and redeploy it into more strategic areas where, whether that is investing in growth, they can also pay down debt or just strengthen their liquidity position. In today's environment, that's really important because it optionally gives them a big advantage. It also reduces the supply chain risk. When suppliers have reliable access to liquidity, they're less likely to run into financial stress, which means fewer disruptions and a more stable supplier base overall. On the supplier side, the value is also meaningful, right? You have the most immediate benefit, which is faster access to cash. So the supplier, instead of waiting 60 or 90 days, they can get paid as soon as an invoice is approved, which really helps with day-to-day operations and planning. It also improves their DSO, which is a key metric for any supplier. A low DSO means that better cash flow and a healthier balance sheet. And most importantly, they're also able to access financing at more attractive rates because the financing is based on the buyer's credit profile, which is often stronger. So with this, suppliers can get funding at a lower cost than they typically would on their own. So when you step back, supply chain finance shifts the dynamic, right? Instead of being a negotiation where one side wins and the other one loses, it becomes a mutual and beneficial financial strategy. Both parties are improving their positions, and that leads to a stronger, more resilient supply chain.
Thank you so much. This is very interesting. But now let's move to how this supply chain finance program can be complicated to implement for companies. So all of this sounds great in theory, but well, I imagine if it's not always easy to implement, right? So what makes supply chain finance challenging to implement it?
Yeah, I mean, it can get complicated really quickly. So there's multiple moving parts. You have different banking products and different platforms that provide supply chain finance programs, as well as different technology with different functionalities, which offer different types of supply chain finance, such as reverse factoring or dynamic discounting. You also have, of course, regional regulations, especially for global organizations where some financial institutions might ask for tax information that need to be added to the invoices, and that creates a lot of complexity. And of course, the supplier onboarding communication, right? So without a coordinated strategy, companies can end up with a fragmented solution that don't deliver the full value based on the examples that I just mentioned.
Mm-hmm. Yeah. Okay. So now after we have been talking about all these program or supply chain finance program, what would be the role in these programs from a consultant perspective? I mean, from an Actualize Consulting perspective, how does Actualize Consulting can help organizations to navigate all through those chain challenges during the implementation?
Sure. So supply chain finance sounds straightforward in concept. However, in order to actually execute it effectively, it requires aligning a lot of moving parts, such as treasury, procurement, suppliers, bank, and the technology. That's where Actualize Consulting comes in. We focus on building a customized supply chain finance strategy that fits each client's specific operating model, supplier base, and overall financial objectives. Because there's no one size fits all approach here, right? We typically start with a program design. That means helping clients define the right structure, what type of supply chain finance program makes the most sense, which suppliers to target, and how to approach payment terms extensions, and also how to balance working capital benefits with supplier impact. From there, we help clients select and integrate the right technology. Supply chain finance programs rely heavily on connectivity between ERP systems, invoicing platforms, and financing providers. So we make sure that technology is seamless and scalable so that we can have a long-term success in the project. Another key piece is establishing the right banking and financial relationships. We help clients evaluate providers, negotiate competitive terms, and also ensure that the program is cost efficient for both the buyer and the suppliers. And that's what I argue is the most overlooked, but most important, which is the supplier adoption. You can design a great program on paper, but if suppliers don't understand it or they don't see the value, then you can have a low participation, right? So we work closely with clients to develop a vendor education and onboarding strategy, which leads to clear communication, training, and ongoing support, which also leads us to make sure that suppliers are comfortable with the program and motivated to participate. So at the end of the day, success in supply chain finance isn't just about structured technology, it's about adoption, right? And our role as Actualize Consulting is to bring all those elements together in a way that drives real measurable results.
Okay, yeah, thank you, Adrian. That's very interesting, all that you have mentioned. And particularly talking about the supplier adoption and communication. You mentioned that this is a very important piece. Why is this supplier adoption such a critical piece?
Sure. So, I mean, the supply chain finance program can only work if suppliers actually use it or discount invoices. So that means that they need to understand the benefits, right? Like improved cash flow and access to lower cost financing and trust the process. So a strong communication and education plan ensures that suppliers see this as an opportunity and not a burden. And when this is done right, it can even strengthen supplier relationships.
Mm-hmm. Yeah, understood. Okay, thank you, Adrian. And now talking about the impact and the flexibility of the program and the strategic of the program, what would be the strategic impact that the companies can expect once the supply chain finance program is fully implemented?
So I would say the biggest impact is flexibility, but it's a very meaningful kind of flexibility that goes beyond just having more cash on hand, right? Once an SCF program is up and running, companies can gain much greater control and predictability over the cash flow. Instead of reacting to payment cycles, they can actively manage liquidity and make more deliberate decisions about how and where to deploy capital. This opens the door to a lot of more strategic opportunities. For example, they can reinvest that freed up cash into growth initiatives, whether that's expanding into new markets, funding acquisitions, or investing in innovation. And it can also be used to strengthen the balance sheet, paying down debt or improving key financial ratios, or simply just building a buffer against economic shocks. At the same time, there's a supply chain benefit that's just as important, right? And this is giving the suppliers access to early payments and more reliable liquidity. Companies are helping improve supplier stability, which in turn reduces risk of disruptions and also strengthen relationships that can even create a more collaborative environment with key vendors. So what's interesting is that over time, supply chain finance can actually become a competitive advantage, right? You have organizations that can run these programs, well, are often seen as the customers of choice by the suppliers, which can lead to better pricing and also priority access to goods and stronger partnerships overall. So when you step back, it really goes beyond finance, right? It improves working capital, that's right, but it also enhances resilience, it supports growth, and it strengthens the entire supply chain ecosystem. That's why we often say that it's not just a finance initiative, but it's also a broader business strategy that touches different parts of treasury, procurement, and even supplier relationship management.
Yeah, understood, Adrian, and thank you very much for sharing this information with all our listeners. And now, as a closing thought, if there's one takeaway that you would want listeners to remember about supply chain finance, what would it be?
Sure. I mean, one takeaway is a bit hard, but I can give a few. So I would say the key takeaway is that supply chain finance is not just about extending payment terms. It's fundamentally rethinking how cash flows through the supply chain, right? When this is done right, it creates a balanced ecosystem where both buyers and suppliers benefit, rather than one side having to compromise for the other. Buyers gain more control over their working capital and liquidity, and suppliers get faster, more reliable access to cash. It also helps reduce risk across the board. You have suppliers are more financially stable, supply chain becomes more resilient, and organizations are better positioned to navigate uncertainty. So if I had to sum it up, I would say that supply chain finance, when designed and executed properly, it improves working capital, it also reduces risk, and it builds stronger, more sustainable partnerships across the entire supply chain.
Great insights, Adrian. Thanks again for joining us on this today.
For sure.
Well, just a final thought on my own is that to all of our listeners, if you're looking to unlock working capital while supporting your suppliers, supply chain finance might be the strategy worth exploring. So thank you, Adrian, again. And well, thanks to all the listeners. We'll see you next time.
We'll see you next time. Thank you.
Thanks for joining us for today's episode of Actualizing Success. Make sure to visit us online at www.actualizeconsulting.com, where you can explore our service offerings. Don't forget to subscribe to the show on iTunes, Spotify, or your preferred platform. If you've enjoyed what we talked about today, please consider leaving a review and following us on LinkedIn. If you have any questions or would like to share your opinions with us, please send us a note at podcast@actualizeconsulting.com. We look forward to hearing from you.